It's joint work with Martin Keller-Ressel and Michael Kupper from Vienna. So what we want to do here is we want to find some kind of an equilibrium approach to price derivative securities. And so up till now, the usual approach to derivatives pricing is something like the following. First, you write down a model for the underlying securities, for example, a stock price. It can be J-dimensional. So you model this as a J-dimensional stochastic process, ST on a probability space, omega Fp. And then you price your derivatives by taking expectations, but not under the real probability measure, but under some different probability measure Q, which you call the pricing measure, or which you call the equivalent martingale measure. And then you have different situations. So you have complete market situations where you can replicate every derivative security by trading in the underlying. And then there is a unique price for this derivative security, and that's just the expectation on a unique equivalent martingale measure. And examples for this are a binomial tree model, the Black-Scholes model, for example. That's actually, I guess, the only two examples that I know of. Complete market. And then more often you're in an incomplete market situation where the pricing measure is not unique. And then you don't really know which one you should take. Or you have some, I don't know, so you have to think a little bit more to find out which pricing measure you should use. So situations for, or examples for incomplete financial market models would be in discrete time a trinomial tree, for example, or gauge type models, stochastic volatility models, models that have jumps in them, Levy process models, for example, or more general semi-martingale models. So in all of these situations, the problem then really is how do you choose one particular pricing measures among this family of equivalent martingale measures in this model. And so commonly used methods are, so for example, you build a model for the evolution of the underlying, and then maybe you do some statistics and you fit empirical data. So and then you parameterize you look at the parameterized family of equivalent martingale measures. Okay, so typically this would then just be a family parameterized by a few parameters, maybe just 1, 2, 3, or 4 or so. Okay, and then you look at market data of traded derivatives and try to just calibrate this parameterized family of equivalent martingale measures to traded derivatives, for example, traded call options, put options, and so on. And then you use this pricing measure to price other things like more complex derivative securities, structured products, and stuff. Okay, so that's something that's quite commonly used in banks, for example. A bit the more theoretical approach would be choose the pricing measure so that it minimizes some distance to P. So this could be relative entropy, some divergence functional, so any statistical distance of Q to P. And the third approach, which is commonly popular in mathematical finance, is indifference pricing. Okay. So what I want to do here is I want to derive the Q by equilibrium considerations from the underlying asset price S. Okay. So I want to show some pictures here because everybody else shows pictures. So so what I'm going to propose is quite simple, and so in fact we have closed form solutions for option prices in this framework that I'm going to present, and that's kind of the pictures for implied volatility curves that we get. So we'll see. So in the rest of the
what model do you use for ST?
Okay, so in the rest of the talk, I'm really going to explain how we came to these pictures. Okay, so I'm going to explain everything, like the theoretical background and then the concrete examples that give us these pictures. So that's what you see here is just implied volatility curves in moneyness, and so the 4 different pictures correspond to different choices for preferences that we chose and different choices of the underlying model. And the different curves in one picture correspond to different maturities. So the green curve here would be the longest maturity. This would be, I don't remember, 8 months or so. The red curve would be a little bit shorter, like 3 months. And the black curve is a very short maturity, like only a week or so. Okay. Okay, so what are we doing here? So what we want to do is an equilibrium approach. So I'm first going to explain what we do just in a one-time step setup. Then afterwards, I'm going to do it dynamically, but only in discrete time. Okay, so for the one-time step up, you start with the probability space. You only have 2 days, 0 and t. So that's today and 6 months from now, for example. And then you have riskless securities, so that's a bank account, for example. You can invest money there, you can borrow money there at the same interest rate. We discount everything by this bank account, so the bank account stays 1. And we have J risky securities paying cash flows at the final time. Okay, but these are random cash flows, so you don't know what they're going to be. And you want to price these cash flows now. So if you take any pricing measure, the price of these cash flows today is just the expectation under this pricing measure. Okay, now I'm going to introduce agents. So I want to have capital I agents. And I assume that these agents, they own all the shares of these assets. And also all the money in the economy is distributed among these I agents. Okay. And at time 0, the ith agent is endowed with eta I j0 shares of the jth security. Okay. Then the total supply of the jth security at time 0 is just mj. That's the sum of all these eta I j0s. I'm going to assume that's non-negative. And the endowment of the ith agent at time 0 is the sum of these things here over j. So that's the different assets that I have in the economy. And now I let the agents trade in the riskless and the risky securities. So I let them rebalance their portfolio. So they're going to rebalance their holdings in the assets from eta ij0 to eta ij capital T. Okay, and then they're going to hold these eta ijt shares of the securities from time 0 to time t. And then this is going to be the final wealth of the ith agent. Okay, and what I need is a self-financing condition here. So that's just a budget constraint, because if the ith agent is going to trade and at the beginning he or she has eta ij0 numbers of assets, then he has or she has to rebalance the portfolio so that this budget constraint is satisfied here. Okay. Okay, next what I need is preferences, and what we're going to do is we're going to work with preferences of this form. So first I'm introducing a reference preference functional. So that's just a functional which is from all integrable random variables to r plus possibly minus infinity, and it has these 4 properties. First I want this function to be monotone in the following sense. So if x is bigger or equal than y, p almost surely, then u of x should be bigger than u of y. I want this functional to be concave, and I want it to have this translational property. So if I add deterministic amount of money to a position x, then the utility shifts by the same amount m. Okay? And this is not so important, but for our examples this will always be the case. I want this functional only to depend on the distribution of x on the p. Say it again? Why do you want to have this distribution dependence? In all our examples, this will be satisfied. If you don't like it, just drop it. Okay?
Every agent has its own mu.
Say it again?
Every agent has its own mu.
Okay, so
One mu for every agent.
okay, so this is a preference functional here, and I'm going to use it to specify the preferences of all the agents. And in the example that I'm going to show you, all the agents will have more or less the same preference. And then I will construct a representative agent, which again will have more or less the same preference. But then again, I can do this with different preferences, and the aggregation still goes through, but will look differently. So I'll explain this. But like what I'm going to show you now is really, so what I'm trying to do here is to have a very simple as possible setup to give me nice smile curves for the option prices. Okay? Then in the end, we're going to discuss in which directions we can generalize this. But what I'm trying to do here is to keep very, very simple. Everything should be very simple. Okay, so the examples that I'm going to look at are of this form. It's a convex combination of an expectation and a risk measure. Okay? So that's just a small modification of mean variance. So if you like CAP-M, for example, your preference would maybe be something like this, and this has been very popular in the economics literature for a long time. It's just an expectation minus some parameter times the variance of x. So you view this as the expectation, you view this as some kind of a measure of risk of your position. Now this has some disadvantages. For example, it's not monotone in a general setup, so you can easily construct examples where you have two positions, x and y, where x is almost surely bigger than y. And still this thing would prefer y. So what I'm going to do over there, I'm going to replace this variance here as a risk measure by a more modern risk measure, like a convex risk measure, for example, which have been developed here. So, yeah.
What do you want to capture by that property T? So you add the deterministic payoff, it won't turn your utility increase by exactly the monetary amount.
So you mean this translation property here?
Yeah, why do you want it?
Okay, why do I want it? Because it gives me a good structure and I can calculate everything explicitly in what I'm going to do. Okay?
Is there any behavior?
No.
There's some behavior. It's according to variational preferences.
Well, I don't want to defend it in economic terms now. So it's just, I do it out of convenience. Also, so this will also satisfy the translation property. Okay? But then economists typically tell you don't really want to have this translation property. Why? Because if people get richer, they will behave differently than poor people, because typically poor people will be more risk averse. And you don't see it if you have this translation property here. But that's only my preference, my reference preference here. So I'm going to do something with this before I'm going to use it as the preference for the agents. Okay, just bear with me for one more slide, maybe. Let's just work with this for one more minute, and then I'm going to modify a little. I'm going to modify it a little bit before I'm actually going to apply it. But at this stage, this is just a reference preference, and it's this convex combination between an expectation and the risk measure. And for the risk measure, you're going to use, for example, this average value at risk here, which again, I think has been given its name here in Berlin. Different people call it differently. So some people call this the conditional value at risk. It's very similar to an expected shortfall. In fact, if the distribution is continuous, and our distributions will be continuous, that's just an expected shortfall. Okay, but then this will not be quite good enough for us. Why? Because it's just an expected shortfall, so it's a first moment. And we want to have something which punishes you a little bit more than a first moment. So we want to have something like a second, third, or a higher moment. Okay? Because what we want to do is we want to make our agents very risk averse to bad events. And the first moment is not just quite good enough for us. Okay, second thing that you could think of is what has been called a spectral risk measure. So instead of the average value at risk, which is basically a first moment, you average over different average value at risk with different levels. For example, you could average with this power function here, u to the minus alpha. Okay, so the average value at risk becomes more conservative when the level of alpha is low. So I'm going to average with the power function like this, which explodes here. So this is going to make me more conservative than just an average value at risk. Okay, and in fact, that's something related to higher moments.
Can you recall me the definition of var u?
Okay. Okay, so the VAR, sorry for that, that's the value at risk. And that's a very popular risk measure, so I guess the most widespread risk measure in industry. Why? Because it's required by the regulation agency, but that's just the negative of a quantile. So you have a distribution with this density, for example, then the quantile, everybody knows what the quantile is. The value at risk is just the negative of the quantile.
And x is the risk factor, right?
And x is your risky position.
Your log returns or?
Yeah, it will be the returns with us.
It will be the return for you.
But for now, it's just a random variable, modeling some uncertain outcome.
So, but everything is static here. So
Until now, it's just a one-time step model. It's okay. Today, you know everything, and you move one time step ahead, 6 months, for example, and you will receive an uncertain outcome, x, and you're going to have a preference function on x. Okay, everybody kind of fine with what I wrote here. So value at risk is this very popular risk measure. It has some disadvantages. For example, it's not convex, which sometimes can be problematic. Say it again?
you're a student of Del Mar, right?
I am, yes. Also, value at risk doesn't really see what happens in the tail here, since it's just a quantile. Okay? And we really want to have something which sees what's going on in the tail here. So whether the tail is like this or like this. Average value at risk is just an average over value at risk with different levels. And you can rewrite it, and basically it's an expected shortfall, and it will see what's going on in the tail, but it will just see the first moment. And we want to have something which depends on higher moments maybe. So okay, in a second step, maybe we want to think about something like this, where we average different average value at risk. So that's just an average of value at risks also, because the average value at risk was already an average of value at risk. But it's nice to write it in this way. Why? Because average value at risk has certain nice properties, like it's convex, it scales, and so this average of average value at risks will keep the same properties. So it will again be convex, and it will also scale. So if you multiply the position x with 10 here, then the 10 comes out of the average value at risk, and it comes also out of this averaging procedure, because I normalize the function here so that it integrates to 1. But that's something that we don't want to have. Okay, why? Because it might be that if you scale a position by 10, you might be more risk averse to it than just to, like would be expressed by 10 times the risk measure of x. Also, we want to do equilibrium with these preferences. And if you take something here that scales, then the whole thing, the convex combination between the expectation of this risk measure will scale, and your equilibrium will be trivial. Okay, it will just be 0. Okay, so what we want to have is something that doesn't scale but is convex, but becomes more risk averse if you scale up the positions. So in a third step, what we're going to look at is this what we call parameter risk measures here. So what we do here is we take weighted average value at risks like this, but with different parameters for alpha, which gives me how fast this weighting function grows here. Okay. Then I penalize these with this power function here depending on alpha, and I take the soup for alpha between 0 and beta. Okay, that's just the soup of different weighted average value at risks. So this still will be monotone, convex, and so on, but it will not scale anymore because it's the soup. It will not be positively homogeneous. Okay, now coming back to your question. So now we don't really want the agents to be translation invariant. So what we do is we introduce these transform preferences U, Wi0, which are Wi0 times U of x divided by Wi0. Okay. Why are we doing this? Because this transforms the preference in such a way that someone who is richer will become more risk-seeking and someone who is poor will become risk-averse. So this depends on the initial endowment of the agent. Okay, that's kind of our way for accounting for this fact that we don't really want the preference to be translation invariant. Okay, and now an equilibrium would be pricing measure Q hat and self-financing trading strategies for all the agents, so that every agent behaves optimally, meaning that if he trades according to this strategy, this will be the optimal way of trading for this agent, and the market should clear. Okay, so demand equals supply. Okay, and so since I have this structure in the preference, it's not too hard to show that an equilibrium exists. The equilibrium will be of the following form. So you sum up the endowments of all the agents and call it the market endowment, WT. And the result is that there exists an equilibrium. And the equilibrium is of this form. So the pricing measure, or the Rodon-Nikodym price of the pricing measure, the Rodon-Nikodym derivative of the pricing measure, is a deterministic function of the return rate of the market endowment. And so this will be in the superdifferential of this random variable. Now, if you have additional assumptions on your preference, for example, if the preference is strictly convex, and this will be unique. If the preference is differentiable in the Gateau sense, for example, you also this derivative here will, this sup derivative will be just derivative and will be unique. Okay. So the pricing measure will be a deterministic function of the return rate of the market endowment. And the good thing is that for the three kind of preferences that I've shown you before, we can write down explicitly this function psi here. Okay, this will just be a decreasing function. So for example, if your preference is just the average value at risk, then this function will just be 1 minus lambda plus lambda over alpha times this indicator function. F is the distribution function of this random variable here, this Wt minus W0 divided by W0. And then more interestingly, if I use these parameter preferences, then the function psi will be of this form here. It will be this term plus this constant times the distribution function of Wt minus W0 divided by W0 to the minus alpha. Okay? That was the one-time step setup. Now I do everything in a discrete time dynamic setup. So I do finitely many time steps. And so still I have a probability space. I have discretely many times. I have an evolving information structure that I model with filtration FT. I still have a riskless security. It stays constantly equal to 1 all the time. And I have these J risky securities, and now these pay cash flows, dJt at every time t from 1 to capital T. And if I take a pricing measure Q hat, then the price of the J security at time little t should just be this conditional expectation of the sum of the cash flows from t plus 1 to capital T, conditioned on the information that I have at time t. Okay, so again, the question is, how do I determine this pricing measure Q hat? And so what I'm going to assume here, so again, I want to keep things as simple as possible. So what I'm going to imagine is that all these agents are traders in a bank, for example, and every day they're just going to rebalance their position in such a way that they're going to make an optimal return until tomorrow. Okay, so these are just myopic agents. They don't think too much. They just want to, today they trade in such a way that it will be optimal for the time period from today until tomorrow, for example. Okay, then an equilibrium will consist of a pricing measure Q hat, and now dynamic trading strategies, eta hat IJT, such that for all times t, I have individual optimality, which means now at every time t minus 1, agent I rebalances his/her portfolio in such a way that it's optimal over the next time step. So that's just from time t minus 1 to time t. Now what I'm going to use here are conditional versions of the preferences that I had before. So they will be indexed by t minus 1. Okay? So these will be the same preferences as before, but conditional versions of them based on the filtration FT. And I want that the market clears at every time step. So at every time little t, demand should be equal to supply. And then again, you can use the same arguments basically as in the one-time step setup, but you do it recursively over time, and you can show that an equilibrium exists. Okay, again, you need additional assumptions on your preference. If the preference is strictly convex, it is unique.
Things like interest rate, you will not response interest rates.
No, I treat everything in discounted terms here. So I'm not interested in the interest rate here. Okay?
It's not a random source, of course, right?
Sure, but okay, I just don't have it in my equilibrium here. Okay, so the pricing measure will be of this form. So the Radon-Nikodym derivative will be a product of one time step equilibrium transition densities, which I call xi hat 1 to xi hat capital T. And at time little t, the one time step equilibrium transition density will be of this form here. It will be a function decreasing of this return rate here of the market endowment, where again this function will be decreasing, but it can depend on omega, so it can be random, but only in an ft minus 1 measurable way. Okay, so it's just analogous to the one-time step up, but I condition everything on time t minus 1 here.
What about the utility? Are there time separable or because of the indices we use? Okay, from back here.
Thank you. So my preferences are only one time step ahead. So the agents just care to optimize.
From time to time.
Yes, yes. So but I kind of in the example that I'm going to show you in 2 minutes or so, I'm going to keep the same reference preference functional, but the way how the preference for like a single investor is going to change is just going to change according to how much wealth he or she is making. If he's earning money, he's becoming more risk-seeking, and if he's losing money, he's becoming more risk-averse. And so that's what's changing for like the single agent. Okay, and now I'm going to apply this for, again, so this is pretty general. I mean, I put some structure on the preference that I use, but then I can use it basically in any underlying model that I want to. So I can write down any stochastic process on the P for the evolution of the underlying, and then this is giving me a way of constructing the equilibrium measure by equilibrium consideration under the assumption of the structure of the preference, but like the underlying is completely general here, so you could use some kind of a semi-parametric model that you fit it really well to your historical data. So what I'm going to do here is take the simplest model that you can possibly think of. So I want to price an option, for example, a call option. I don't really need to do that because these options are traded, but I just want to see how well this approach works. So I want to price a call option. So what I'm going to do is I'm going to specify a model for the aggregate market endowment WT and one particular stock, IBM stock, for example. That's SJT. Okay, and I'm going to model these two as a two-dimensional stochastic process in discrete time. And I'm going to assume that for the time period that I'm looking at these two, the stock is not going to pay dividend payments. And I'm going to assume that the whole situation, the market is in equilibrium. Okay? And what I want to do is I want to price a European call option on S, so this should be SJ here on this IBM stock, for example, strike price K and maturity T. This has this payoff function here, this payoff function here, which is uncertain. If I want to price it, I take expectation on the sum pricing measure, so I'm going to take the equilibrium measure, which will be unique if you have these additional assumptions on the preference. And this is going to be CKT. So I want to calculate this. Okay, so what I'm going to do is I'm going to model the returns of these, of the market endowments and the J stock. Denote them by RWT, RJT. And I'm going to assume that they are IID over time. Okay, that's not particularly a realistic assumption here, but for simplicity, I'm going to assume they're IID over time, but they're dependent between them. Okay, so it's a two-dimensional stochastic process. Two components will be dependent, but this process will be IID over time. And what I'm going to do here is I'm going to specify the marginal distribution of the return of the market endowment. I'm going to specify the marginal distribution of the J stock. And I'm going to use a copula to model the dependence between the two. Okay? And this is going to be important for us because what you need is you need some tail dependency here. Okay? So, and to really get these smiles. So basically what we need to get...
You're saying only with tail dependency get the smiles?
So what we did up till now is just play around with different examples. And we wanted to get nice pictures. And what we found is to get these nice pictures, you need two things. You need a preference which is really risk-averse towards bad things. So first moments are not so good, so it will help you if you use higher moments. And you need some tail dependence here. So if you just model this as a bivariate normal with some positive correlation, you don't get these really nice smiles. So it helps us if we have really some more severe dependence here between these two events.
You will show us the copula.
Say again?
You will show us which type of copula you use.
Yes. Okay. So I specify the two marginals and I couple them with the copula. As a preference, I'm going to use this convex combination between an expectation and a risk measure. The risk measure will be this soup of penalized weighted average value at risks. And so what will happen if you fix W, this soup over alpha will be attained at 1 alpha. okay? Then you will just have one weighted average value at risk for this particular alpha. And the average value at risk was an integral over the value at risk. Then you have a double integral, you change order of integration, and you can write the whole thing like this, just as a weighted average of a value at risk. And the weighting function looks like this. It's again a power function, okay, for a particular alpha. What I'm going to do is I'm going to introduce this distortion function kappa, which is the integral of this weighting function f alpha times the derivative of the copula with respect to the second argument. And okay, what you can show is that the distribution of the return of the stock price that you have the option on changes from P to Q hat like this, okay? So this is the distribution function of this return on the P, and that's the distribution function on the Q hat. What you have to do is you have to distort the distribution function of F on the P by this distortion function kappa, which depends on the preference and which depends on the copula, like this. Okay, and you have the convex combination between the expectation and this risk measure. So this part is just 1 minus lambda times the distribution function on the P. The characteristic function transforms like this from P on the Q. Okay, it's not so important, but we have explicit formulas here how the distribution function changes from P to Q. Okay. So what we're going to use here, for example, is a Clayton copula. Okay. So again, I mean, that's just an example that we chose. It's a one-parametric family. It has a parameter theta. It looks like this. And if we fix alpha, then for different parameter specifications of theta, we get these kind of shapes for the distortion function kappa. And now I want to calculate the price of the option. So what I'm going to use, I'm just taking the expectation under this distribution and I have it in closed form. And so I'm going to use the characteristic function. So I'm going to do Fourier transform a little bit here, and transform back. And that's a method that has been mentioned before, and I guess appeared first by, in a paper by Carr and Madan. So what I'm going to do is I'm writing the log return as the log of 1 plus the return rate. Then I write the characteristic function of the log return on the Q hat. Looks like this. And now I'm going to use the independence assumption over time. So the characteristic function of the sum of all these log returns is just a product of these characteristic functions up here. So it's just this thing to the t. Then I introduce the logarithm of the moneyness of the option. And I can write the option price as the expectation. I take S0 out of the expectation. I have this formula here. I do Fourier transform. I modify a little bit. I transform this thing back. And I get this explicit formula here for the option price. Then for these pictures, we use the variance gamma for the returns, just to fit the distribution a little bit better than with the normal. But so this is not so important for these pictures here, what you actually use for the marginals. So what's important here is what dependence structure you have and what kind of preferences you use. And then that's these pictures that I...
Now you should universally calibrate this to the IV smile.
Okay. So that's what we've done so far. So we have like some theoretical background for all of this thing. We did this very easy example here. Further directions to go. So what I did here, I only priced options with fixed horizon, European options with a fixed horizon. Okay. So if you want to price path-dependent options or something, you might need a more complex model for the underlying, which has like the correct dependence structure. So you might want to use a Garch model or some kind of Markov model here for the underlying. You can use heterogeneous agents. So here all my agents had the same preference, and then everything just depended on the aggregate market endowment. If you use heterogeneous agents, you can do the same thing, but everything will depend on a weighted average of the endowments of the single agents. You could model agents who optimize over longer time horizons. Actually, we can do it here. It becomes much more technical. It didn't help us much in getting these nice smile pictures. So what we have here is, so in this simple example, I just had 2 parameters for the preference and 1 parameter for the dependence. So I had 3 parameters. I could use these 3 parameters to now really calibrate to market data of traded options. I could introduce more parameters, 4 or 5, and then maybe my calibration would be a little bit, is certainly more flexible, maybe a little bit better. And then, of course, pricing of more complicated products like path-dependent options, for example. Okay, thanks very much.
Questions?
Yeah, what was capital I and the number in your plot? The number of agents, or we statisticians like to let capital I tend to infinity.
Okay.
I'm asking this question.
Capital I was the number of agents in our economy. So do we want to let I tend to infinity? Because in the end, we're really only interested in the representative agent here. And so I haven't thought about this.
Because you also have a sum of something, right? And then this will get an integral of
Well, here it doesn't depend on I, because my representative agent will just be the reference preference functional on the aggregated market endowment. But then if I have heterogeneous agents, it will depend on I. So maybe we'll want to look at what happens if I is large or small. And,
yeah, exactly.
Okay.